The market is flashing some, well, let's be honest, warning signs up here. And over the past 5 trading sessions, I've seen more liquidation breaks than I can remember in quite some time. But so far, the Santa Claus rally marches on, and the warnings aren't actually actionable for big downside trades. But there is one level in particular that you need to be watching into the new year. We'll discuss what that number is and all of the supporting evidence as we wind down the last 2 trading days of 2023. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. Zooming into the SPY daily time frame chart, you can clearly see that the trend remains in the upward direction. We have lows, higher lows, and higher lows because we did definitively flip into hourly downtrends in both of these instances. We have been in an hourly uptrend ever since reversing off of the lows of Wednesday from exactly a week ago today. And along the way, we've just produced a brand new higher high in the trend count over the Wednesday high from once again a week ago today. So we remain firmly in an overall daily uptrend, and we've also broken out of this as a daily balance area. So to me, we are looking for follow through in the upward direction. The measured move of a range break, as we know, is usually a doubling of that range, and that takes us closer to 481.50 as a target. And the Santa Claus rally measured move target is here at 480.25, just north of the all-time high at 479.98. The upper edge of the weekly expected move is up here. 480 is the next major overhead thing to be aiming at if we get continuation of this range break in the upward direction. And as of right now, things are bullish, right? Today's session is actually an inside bar in the upper 50% of Tuesday's range. Again, that has to strike me as being more bullish than bearish. But you might think to yourself, well, Matt, since we have a higher high, we're in an uptrend, we can technically afford a pullback, right? And you're absolutely correct. Technically speaking, we can afford a pullback, and the higher low that you would want to find on the daily time frame chart is somewhere here at 471.50. However, this is not the line in the sand I was referring to in the intro. Instead, the level is right here at 473.75, and it should become crystal clear on the hourly time frame chart as to why. It's the Wednesday of last week, so a week ago today, it's where the liquidation break accelerated underneath the morning low over here. Into the Friday session, it's the same exact thing. Sellers accelerated underneath that level. So if we were to violate that, sure, you could get your daily higher low pullback here at 471.50, but we've already broken down through key structure. Tuesday of this week, we saw a liquidation break into the close, and to me, that's an indication that buyers late to the party here are getting a little bit nervous. And the same thing happened on today's session about midday. We formed a new high of day, then we actually broke down to a new low of day, only to rebound into the close. So as I said in the intro, we don't actually have an hourly downtrend yet. We don't have an actionable setup to trade in the downside direction, but the buyers do appear to be getting nervous at these highs in the trend sequence. So if we fall underneath 473.75, sellers are emboldened in my eyes. Buyers liquidate from up here. They turn into overhead supply, really. And we're looking for basically a look above and fail, right? If this is a daily balance range and we have a range breakout and it fails, underneath 473.75, look for a lower high, and I would start to think about this, not so much the saving grace here at 471.50. I mean, is it possible that you could technically get a daily higher low there? The answer is yes, but I would imagine that you get too many trapped longs up here at the highs towards the end of a fairly impressive run, let's not forget, and then we look for a little bit of a deeper correction, a little bit of a deeper pullback. Now again, there's no indication of this happening yet, other than the warning signs that buyers are getting nervous near these highs via the multiple liquidation breaks. Number 1, number 2, let's actually do this. Number 1, number 2, number 3, number 4 into the end of day yesterday, and number 5 midday on today's session. So walking forward, what is the name of the game? This has to strike me as bullish consolidation. Yes, higher lows that look like this, fantastic. We will trade in the upward direction. Even if we pull back, sweep the low of today's session, if you find a higher low over 473.75, I still think that the bull case lives on because you are above that key inflection point. You are looking for, okay, you grab some liquidity down here, then start to rotate in the upward direction. You're still then looking for something that does this over time, and the target has not changed through all of this. 480 is still the key level overhead. If we slip all of this to the downside, you guys already know where my head is at. We're thinking about something that looks like this, and the danger of this type of situation here is that we're trading back to the equal lows basically on the daily time frame chart, sure, after a higher high, but if we were to knock on this one more time, I imagine that the door opens up. You have test 1, you have test 2 under very extreme circumstances. Test number 3, and you're probably going through. Even if it requires a lower high underneath here first and then a reattempt, you're probably going through on test number 3 or 4, and then we flip into a daily downtrend, knowing that we usher in some sort of lower low underneath 468.50. So that is my concern to the downside. Again, I want to be very, very clear here. We do not have an hourly downtrend yet. There is nothing bearish about this indication. We have warning signs that buyers are getting a little bit antsy up here at these highs, but as we'll see through the supporting evidence, most of the charts still align with a risk-on rotation. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Very simple analysis, just compare and contrast Tuesday to today's Wednesday session. Clear volume inflows today, not so clearly defined, just sideways. Grinding higher towards trend higher zone today, just sideways and closer to the zero line. Cumulative build out of the tick down below. Strong build on Tuesday today, ending the day flat. So you can clearly see the difference in price action as well. Nice move in the upward direction, and today much more sideways with an end of day ramp, causing that nice solid green close. So overall, I think that the internals align with more so that, yeah, it was a neutral, maybe even slightly bullish balanced day up here, but buyers are clearly getting tired at the exchange level, and if we slip some of that key structure, I think you can bring in a larger downside move. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. What was happening with the value area and point of control? Here is Tuesday and here is today's Wednesday session. In terms of value area, mostly overlapping today was contained inside of Tuesday's value, and the point of control migrated slightly in the downward direction. So first take might be, oh, this is bearish, market's got to go to zero, nobody wants to transact at these highs. You're not technically wrong, but I would take a bullish spin on this, maybe just a saving grace spin, right? Let's just imagine if value area and point of control were slammed into the highs from Tuesday, slammed into the highs of today's Wednesday session, you would require the market to see a two-day high breakout and not look back, right? Because what would happen is longs would have the worst possible trade location if value is here. If value and point of control was here, longs have basically bought the highest highs, and they need to remain over that level if they're going to remain constructive and green on their positions. With value area and point of control slightly lower, sure, nobody really wanted to transact at these highs, but at least the long position is being held from a slightly lower place. We know that we're in uptrends. We know that the buyers have the upper hand here. So because we can assume that more longs were transacting than shorts, the markets did ultimately move higher, right? Then the long is being held from a slightly lower place. Now, don't get me wrong. This is not a saving grace. The equivalence of your 473.75 in the ES futures is right here at 48.08. That's where your single prints are really unlocked from Wednesday of exactly a week ago today. But what it would indicate is that we can at least experience a two-day high break that comes back down into range, tries to find an hourly high or low, and then continues in the upward direction without running the risk of this instantly turning into overhead supply and another long liquidation taking us in the downward direction. Now, if we were to break down underneath 48.20, yeah, different story. This can turn into overhead supply. This can turn into overhead supply, and we'll look for 48.08. But as of right now, with the long position being held slightly lower, not pressed into the two equal highs, you get a little bit more leeway at these highs for a break and retest that is not as cleanly holding the two equal highs. You can dip a toe into the two range and then come back out of it without jeopardizing big overhead supply. Let's change gears to the QQQ daily time frame chart. Now that we've covered the S&P 500, that will act as our blueprint. A lot of the same commentary, just slightly different levels happening here. We are, of course, in a daily uptrend, and we just broke to two equal highs, higher highs, over the Wednesday liquidation break high from last week. And we, of course, have a breakout of this as a daily balance range. And if we were to double that range in the upward direction, we're roughly looking at a target of 416.25. And that, of course, implies a big new all-time high. We're trading at all-time highs as we currently speak. Upper edge of the weekly expected move is 414.75. If we do pull back, there is an opportunity for a daily higher low to hold at least an equal low, if anything, at 406.50. So something that looks like this. You're still tracking for lows, higher lows, higher lows. This could certainly act as a higher low coming from the higher high. Because this was a lower high, I wouldn't really count it in the lower wick of that individual bar. We also didn't really flip into an aggressive hourly downtrend, right? So 406.50 is your daily higher low line in the sand. But as we talked about on the SPY, we actually know that there's a level in between there that we really care about. And in the QQQ, it is 408.50. 408.50 has all of the same characteristics as our SPY 473.75. It's the opening print on the Wednesday of last week before before the liquidation break really accelerates. We failed to clear it here on the sort of Thursday follow-up. On Friday, it's where we get that afternoon breakdown. So same exact indications. And if we do slip underneath here at 410.25, technically you're already failing back down into this as your daily balance range, but I would still be thinking about, can we get a higher low that looks like that? You're still getting the liquidation break on the Tuesday end of day session. This afternoon, you still got the liquidation break off of the high of day. You've closed near the high. So once again, I want to be very transparent here that there is nothing inherently bearish about the chart in its current form. But if we were to break down, slip a lower high underneath, sure, there's a short trade to here. I would put my thinking cap on and say, okay, can we do this into the future? If we can't hold 408.50, that's where the bears really, develop their edge. And I would say that they, again, just for a lack of a better term, sellers become emboldened underneath that level, right? So there's some sort of breakdown, we get consolidation, something that looks like this. You're probably looking at the bottom end of the balance for a true look above and fail. That is the downside outcome. Obviously, trading up and over 411.50 like this is just ideal rainbows and butterflies bullish consolidation, break, higher low, all-time highs, blue sky territories. We know that the measured move target we're thinking about is roughly 416.25. We've got a ways to go until we actually hit that. You could also think of this as just sideways consolidation. It's technically a balance range, right? It wouldn't be unreasonable to say, okay, this could also act as a potential target. That number might be somewhere closer to 413 as and if we break into the end of this week's session, right? So overall, thinking about bullish outcomes first because we are in an hourly uptrend. We have lows, higher lows, higher lows. These could certainly act as higher lows, or even if you get a breakdown, right? If you can support off of 408.50 because we're coming from the higher high, you can still get a higher low here, which is why we're not bearish until we slip for a lower high underneath that. And then we have the look above and fail. So we're fairly straightforward on what sort of opportunities exist here. And the number that everything revolves around is really your over and under of 408.50. Bullish if above and bearish if underneath. Let's take a look at the NASDAQ internals. How did we do this week? Better inflows on both days. Certainly the Tuesday session up and over 400 million, and even into today's afternoon session breaking up and over 400 million. The advanced decline line, though, more similar to our S&P 500, or I should just say NYSE exchange level internals, going sideways on today's session, a little bit more impressive on the Tuesday, and the same thing out of the cumulative build, stronger on Tuesday, really flat, almost negative into the close of today's session, negative 479 technically speaking. It's basically flat in terms of relative ups and downs out of the cumulative build. So again, wouldn't be unreasonable if the market slips underneath some of those levels over on the QQQ. If we can slip 408.50, we know the buyers are somewhat tired up here. So maybe just dial back expectations of a big long, but certainly don't be trading shorts until we violate some structure. I would not want to just blindly be shorting the highs because we can see that, oh, look, at the exchange level, the tick is fairly neutral. No. We really just had a sideways day until we actually flip into an hourly downtrend, until we actually break that QQQ 408.50. I wouldn't be aggressive looking for larger shorts to sort of materialize and bring that vision into fruition. Let's take a look at the NASDAQ market profile here. Let's go ahead and auto zoom this. There we are. Some things to point out. We did repair the poor high out of the Tuesday session, and you can see the same phenomenon. Value area point of control is here. Value area point of control is here. It is slightly higher on the day over day session as compared to the ES futures, but for the most part, the same takeaway really stands, which is that the average position is technically held at a lower price point as opposed to slammed up into the highs. Now, we do have a lack of material excess at the highs of today's session. Same thing at the lows, lack of material excess here. So first thought is if we can break and hold over this high, that's a great repair of structure. We'll look for the market to continue in the upward direction. If we start trading inside of the previous day's range after, let's just say that we open and quick sweep through it, I would start thinking about, all right, this starts to become attractive. Now, again, are you overly aggressive underneath that low? Probably not. The bigger level that you would want to be concerned with at the NQ futures is actually down here, closer to 16,975. 16,975 is the level that we've been tracking in the pre-market, and that still stands as your key line in the sand. That would be the equivalent of your 408, was it? Let's go back over here, 408.50 over on the QQQ cash. And not using the same blueprint is the IWM Russell 2000 and the small caps. Let's begin on the daily time frame chart. You can clearly see that if this is the balance range, we have much more of a meaningful breakout from the range. Instead of these very incremental higher highs, you actually produced a higher high today and closed outside of the Tuesday session, and you're far outside of the Wednesday highs from a week ago today. So in the IWM small caps, this is a much more constructive break in the upward direction, and not for nothing, but we do know that a range doubled measured move move is closer to 208, which is also weekly structure here. So that's our upside, and the chart looks far more constructive in the upward direction anyhow. As a matter of fact, let's take it on out to a weekly time frame chart just to illustrate that this could potentially be one of the larger opportunities in the small caps, breaking from this as a balance range. Now, don't get me wrong, we've gone wall to wall and some and broken out of the monthly consolidation, but so far this speaks to the broadening nature of the market rally. We've been harping on that point for the past couple of weeks, and that's continuing to play out in the upward direction. Let's take a closer look at the hourly time frame chart though and really understand if we're getting those same indications about a key level in small caps. And the answer is quite frankly just no. I mean, there are plenty of opportunities for a higher low. Ideally, it stays over the top of the daily balance area here at 202.20. I mean, we could make the argument that this is the equivalent level, but you're still looking for a strong daily higher low in that case coming from the highest high in the trend sequence. Remember that this is a daily range. We've broken out of the daily range. If we were to pull back because we're coming from the highest high, this can still act as a higher low, and it is not necessarily violating the low from where the liquidation break ultimately accelerated on the Wednesday session of a week ago today. Now, don't get me wrong, the acceleration was here on the Friday session at 202.20. Would it be ideal for IWM and small caps to remain over the top of the daily balance for something that looks like this? Absolutely. But I don't think that you're still going to get those emboldened sellers even if we dip a toe underneath. I think there's a strong opportunity for your IWM to still catch itself for a higher low. It looks far more constructive on the higher time frame charts like the weekly and even the daily breaking out of that balance. Here on the hourly time frame chart, you could start to think of this as a stronger bull flag indication. And if we can get some follow through, we know that the range double target is up around 208. If we do start to pull back, again, it's not the end of the world. We have plenty of reference points underneath us. I would firstly be thinking about, can the IWM and small caps catch a higher low at 202.20? Not for nothing. I haven't done this, so you're seeing it in real time with me here. Let's take a look from Tuesday's low up to today's high just to gauge the 38.2, and not for nothing, if this is going to act as bull flag consolidation, let's just zoom in on this a little bit here. Technically, we held it to a T on today's session. Notice how, sure, there was a little bit of volatility into the end of day Tuesday. That's technically yesterday. But here is today, right? Is that yesterday? No, I'm sorry. That's 10:30 this morning. The liquidation break was earlier in the session. There's your from high to not making a new lower low. And this is very mild into the Tuesday afternoon. My apologies. I'm all screwed up here on our IWM. But regardless, nice hold of the 38.2, classifying this as bull flag on the hourly. If we can get a swing up and over 205.44, you guys know the deal. We just talked about this target numerous times at 208 from a daily and even weekly point of view. Stronger downside only comes in if you're looking for a downside trade in the first place on a lower high underneath 202.20. Then we can trade for the daily higher low at 199, because at that point you would certainly be in an hourly downtrend, breaking from the highest high to a lower high and also finding some sort of lower low underneath key structure, the top of the daily balance at 202.20. So we know our ups from downs over here. We know that the longs are a little bit more constructive in IWM. I would certainly be thinking about this as a primary objective into the very near term future, higher lows over that level. If we slip it, you guys know the name of the game to the downside, but still thinking about daily higher lows here. I mean, just a very, very strong looking chart on the higher time frame, searching for how can we participate responsibly in the upward direction. Let's take a look at the market internals for the, I was about to say NASDAQ, but the Russell side of things, more similarly mirroring what we had in the S&P in terms of breadth, more neutral over here. Same thing with the advanced decline line, getting tangled up around the zero line on today's session as we're a little bit more neutral and chopping around there. And you can see that we actually build out a negative build from the cumulative build. Strong move on the Tuesday session here. Taking a closer look, a lot of this volatility actually kicked off around the bond auctions on today's session, that 1 o'clock time frame. You can see we were up before it and then sort of down into it and then flat into the close here. So volatility should be perking up, but as we'll find as we move through today's supporting evidence, it's really not. So let's finish off the IWM small caps here with our market profile. And what you'll notice is that we have a total normal distribution on today's session. Very balanced day. And I think that's very, you could visually see that here as well. Very, very balanced, two-sided trade back and forth activity taking place. If the sellers are going to make something happen, coming back over here, what you would primarily want to see is a failure to hold this level. And what do we know about this level? It's the equivalent of the top of the daily balance range. And that number in the Russell futures is 2070 roughly. So underneath 2070, we can look for some downside. Other than that, I mean, this is looking healthy to me. The point of control did technically migrate in the upward direction as we had a normal digestion day. This was a trend higher day. This is pretty balanced as well on the Friday session. So no big concerns out of the small caps through the lens of a market profile here, this poor high has been repaired. Great excess in H period and D period at the highs and lows of today's session. Nothing overly concerning. We know that we can drift higher or pull back and still remain healthy from a trend point of view in small caps, which is bullish for the broad market as a whole. Jumping back on over to the platform to evaluate the weekly performance of our sectors shows us that we have real estate leading the pack up 1.18%. As we know, that's a lightweight sector and it's very, very rate sensitive. Not the end of the world to see it towards the top of the list, but it's followed by consumer staples, industrials, and healthcare. A lot of those, at least consumer staples and healthcare, are D for defensive. Then it's utilities, and then you start to see some of the more risk-on indications like financials, discretionary, tech, communications, much lower in this list as the market's trying to break out for continuation in the S&P 500. Now, to me, that's not exactly what you want to see here. Of course, the XLK, XLC, XLY, all of that stuff, all the risk-on sectors, XLF as well, really, have pulled their weight over the last couple of weeks here. But if you're looking for another leg higher in the S&P, generally speaking, as this rotation is taking place, you want to see the risk-on sectors cooling off. You want to see the risk-off sectors really, picking up some of the slack. And then as the breakout resumes, that's where the risk-on sectors are like, okay, give the baton back. We're ready to sprint again, right? And that's just not the case as we're begrudgingly moving out of this balance range on the daily time frame chart. I think that this more so aligns with some of the hey, buyers are kind of nervous up here near these highs because we're not really seeing the follow through, or at least relative performance out of the risk on sectors. The only red name on the board here is the energy sector, which, not the end of the world. Let's check in on the structural charts though. I mean, real estate, it looks great in terms of this V-shaped recovery, equal high reattempt, and then a break would be bullish for real estate. But unfortunately, it's just such a lightweight sector for the S&Ps that it's not going to help us, really, sprint towards that all-time high to keep up with the running metaphor here. What's going on with consumer staples? Again, some relative outperformance here, but not a leadership concern. I mean, over the last little bit, sure, it's more aggressively moved in the upward direction, hence the top of the leaderboard over here, but it's not hanging out near all-time highs. So it's picking up some of the slack, but not we don't want to see that happening as the market's trying to break out towards all-time highs. Industrials, a little bit better, understanding that this is roughly 8% of the S&P. It's definitely more of a risk-on and economic boom style indication as well here out of industrial. So I like what I'm seeing, but healthcare, I mean, if we just continue to walk through some of these D for defensive sectors, relative outperformance over, sort of the last 3 trading days. Now, don't get me wrong. We don't want the risk-off sectors falling off of a cliff. We don't want them underperforming to a substantial margin where it's like all of a sudden, okay, what the heck is going on with this market? But if the market's trying to break out of that SPY daily balance area we were just looking at, generally speaking, we want to see that led by the heavier weight risk-on sectors, and that's currently not the case based on this distribution up here. What are utilities doing? These are really just going sideways, nothing important to write home about in utilities. It's not a risk-off indication seeing this over tech, but if we look at financials, I mean, they're kind of stagnating. Maybe we get a little bit of a range and then a break for continuation. That, of course, would support the bullish thesis, and don't get me wrong, this is not a bearish-looking chart. There's nothing about this that's bearish just because it's lower in this lineup, but it's not really breaking out of the range yet. If it breaks out of the range, that would be supporting evidence that the S&P rally can continue. If it kind of fails and just chops around up here, I wouldn't want to be participating aggressively long in a rally in the S&P that's solely driven by returns in real estate, right? That's kind of the nature of what we're getting at here. XLB Materials is the lightest weight sector. And again, it's already broken out of its daily balance range. I'm not calling this a bearish chart, but this shouldn't be leading the S&P in the upward direction, noting that it's over discretionary and tech, right? Speaking of the two, let's take a look at them. Again, they continue to consolidate up here. This is not a bearish chart. I want to be very clear about what I'm trying to get at. The essence of what I'm describing, right, is that the risk-on sectors are not causing the daily break of the SPY balance. I'm sure you're like, Matt, I get it already. Shut up, dude. Just get through the charts. So something that looks like this is much more constructive, but for the most part, if we just consolidate sideways, again, a little bit more reserved in that S&P breakout. Same thing with the XLK. This does look much better to me than what we just saw in the XLY. Notice that we have multiple lower wicks, lower wicks, lower wicks on today's session. We're pushed right into that all-time high. This could easily pop that into the end of the week, and the Santa Claus rally could live on, and you'd be much more confident in your S&P 500. Speaking of tech, let's take a look at the SMH. What's going on with semis? New all-time high on today's session. Red close, but still new all-time high was produced. This does strike me as like a little bit of a sigh of relief. Like, okay, things do make a little bit more sense here, seeing that semis are continuing to aggressively push in the upward direction for that all-time high. Next up, communications, a little bit flatter, but again, not a bearish pattern, just consolidating. We would ideally like to see this pick up the slack and move in the upward direction towards some of this overhead gap. Over 73.20 closes up towards 75.25, and XLE to finish things off. The only only red name on the week thus far, really doesn't look all that bad. This still certainly could turn into an inverted head and shoulders. We don't really have much of a right shoulder that's built out yet. We're kind of struggling around this neckline, a little bit indecisive around the 50 SMA. Another pullback in here, some more consolidation, and then a break. Certainly looks okay. Let's quickly check in on crude and just see what's going on. With crude itself, how is this responding to everything that's happening in the world currently? It's rebounded off of these lows on the Red Sea tensions, but we're kind of just hovering around a previous rejection point, right? So prior support turns into newfound resistance. If this drops off, I wouldn't be surprised to see energy take a turn in the downward direction. And sure, it raises some concerns about global demand, but overall, it would certainly be a disinflationary force, which is what the Fed wants to continue to see. We just want to make sure we don't slip into deflation or global sort of stagnation, if you will. So the best case outcome here, in my eyes, is a sideways crude or slightly higher crude to get more so in alignment with like $80 a barrel, something along those lines. We obviously don't want it ripping in the upward direction. Everybody would hate that, but it would speak to global demand picking back up, maybe avoiding some of those recessionary themes. Just to continue along in the lineup of sectors, let's jump on over to our ratio grid here. And what we'll notice is that, again, tech is sort of stagnating, at least on a relative basis. Same thing in the XLF, trying to get an uptick. But as we know, these things are pulling back from higher highs. This is kind of an equal high back here. Tech really wants to get in gear. It wants to break out to that all-time high. It wants to outperform the S&P. That would feel much more comfortable. So that will be a top watch for me into the end of this week. XLV is trying to pick up off these lows, but just remember, it's aggressively underneath a downward sloping 50 SMA. That's not a concern as a risk-off indication. XLY more so similar to the XLF, pulling back mildly, nothing aggressive after setting a higher high, more similar to that XLF, which we were just talking about from here to here. Certainly an opportunity for a higher low, certainly an opportunity for a higher low from here to here. Industrials look good as well. Remembering what we commented on over there, XLP still underneath a downward sloping 50 SMA, same thing with utilities. So we are not getting a risk off rotation. I want to be very clear that, although we were very explicit in what was leading sort of the exit of the SPY daily balance, we don't have a pure risk off rotation. You just want to see to have more confidence in getting to that all-time high in the S&P, relative strength return to the big heavyweight risk-on sectors like the XLK, a little bit more dialed back in confidence if it's being led by what's currently up here on the leaderboard, real estate, staples, healthcare, and utilities. All right. Next up, let's take a look at some specialized ratios. What do we have out of the XLK SHY? Still looks like a bullish risk-on indication to me, hanging out near these highs. That is not a big concern. Same thing over here in XLK over the XLU. Highest highs in the trend sequence after a higher low over an upward sloping 50 SMA. Good to go on that front. And apples to apples here on the, we just looked at this one. Let's take a look at the XLY XLP. Certainly, again, pulling back mildly from a higher high after a substantial break out of this as a long-time balance range. The 50 SMA is starting to curl more aggressively in the upward direction. Higher lows are welcome out of this ratio, and it would continue the risk-on sentiment in our marketplace. Let's take a look at the dollar and see what's going on with the good old Dixie making a new low on today's session, at least from this balance range, breaking down to a new low, which, as we know, alleviates some of the headwinds over here in equity. So it does make sense that we have an easier time moving in the upward direction there. Let's see if the gold contract agrees. One thing I want to point out, let's actually zoom way the heck out in gold before we take a closer look. Let's go max available. See what we can get here. Not for nothing, but one of the larger cup and handles I think I've ever seen. If gold can certainly get some more clearance, a little bit more confidence near these highs, I mean, you're talking about it's being rumored like, oh, can we get a big hyper or super cycle rather out of gold as we move into 2024? Can we see this big, break in the upward direction? It's something to be thinking about. Of course, it would suggest that the dollar might continue to move in the downward direction, which in theory would be bullish for equities, but it raises some questions. Why would there be a huge flood into hard assets like gold? I could understand things like copper from an EV perspective. I could understand, some things that are more associated materials-wise with chip making, but gold, a little bit less. This does strike me as like, okay, a bit of a head scratcher on the higher time frames. Like, why are we getting this rush to a quote unquote safety mechanism, hard assets like that? Let's take a look at silver because we know silver has been a precursor to gold. Let's drop it on down to a reasonable time frame again, like the daily. One thing I want to point out here, and we'll flip back to gold in just a second, is that this is, silver is not aggressively in the upward direction. Take a look at this current silver price action over here, and then take a look at something like gold and what gold did on today and even the past couple of trading days, right? It's broken out up and over over these highs. And as we know, silver has been leading gold recently, and the metals to me have always been a heartbreaker trade. I don't know if you guys have ever tried to trade the GLD, which is just the ETF. This thing is like, unless you're swinging it on a long duration basis, it's a day up, a day down, a day up, a day down. It's very, very choppy. It's not an easy thing to trade the metals unless you have a long time frame duration or you're an intraday scalper. So just understand that if silver's the true, like, hey, let's stay grounded in reality, gold's breakout may turn into a fake out. And what that could mean for equities is really more so sideways activity here or a slightly lower move to instigate some sort of like weekly pullback. It's one of the dynamics I'm paying attention to on a larger time frame as we move into the early stages of 2024. But for this week's session, the last 2 trading days of 2023, I think that this can sort of take a back burner. So let's move along and get off of that sort of intermarket relationship. Here's the TNX 10-year yield is just falling off of a cliff. As we know, this is bullish for long duration tech assets or risk assets, of which the tech stocks are the longest duration risk asset there is. So to me, this is a sort of a tailwind. It's no longer a headwind as we were up over here. Let's take a look at the inverted ZT. So 10-year rates are coming down. What about the 2-year? 2-year is aggressively falling off as well, signaling that, hey, the Fed pivot is likely around the corner. Let's take a look at the tracker tool now. All right, we're only looking at this because in the last clip I said we would look at this. Otherwise, I would have omitted it in its entirety. Something is going on here technically with the chart, or the data at least, which is incorrect after the maintenance period from this afternoon. So we'll update a screenshot over on the X app for tomorrow morning once this sort of straightens out. The Fed would absolutely not cut rates just to hike rates one more time. They would hold them steady throughout and then start cutting from there. So this does not strike me as a reasonable thing to even dive into or analyze. The main takeaway, I suppose, is just that, yes, we are still expecting a fairly aggressive amount of rate cuts into 2024, which, as we know, should, in theory, continue the multiple expansion rally if the promise of rate cuts is ultimately fulfilled. But let's not spend any more time on that glitched out chart. Let's take a look at risk appetite. TLT ratio to the S&P continues to break this trend line over here, but if you read multiple sort of 2024 outlooks, a lot of money managers, we're talking about people that control a lot of capital, right? They're locking in higher rates while they can. So it does not surprise me to see the TLT doing something like this under the premise that the Fed will cut rates in 2024. We want to lock something in with a longer duration, TLT being the 20-year, makes a lot of sense that it's slightly outperforming as people are flooding in ahead of the anticipated rate cuts. Is it a flight to safety style trade? The answer is just simply no. If you look at bonds in relationship to themselves, this is clearly moving in the downward direction, breaking lower on today's individual session. What this would illustrate is, once again, a longer duration appetite for risk. There's not a flight to safety into short-dated, government-backed, very, very safe assets like something, the SHY basically over here. And we can continue to pair it with credit spreads. We know that this has not been an issue for quite some time now, breaking down underneath the 50 SMA, starting to roll over here. There were slight concerns about a counter trend move, but it was exactly that, just a counter trend move in the context of an overall move in the downward direction. So overall, the TLT chart, once you provide some context, really isn't all that scary. If we take a look at the HYG in isolation, breaking to a new higher high into this afternoon, whereas the S&P, you can clearly see equities were basically flat. So if anything, this is a risk on indication saying that, hey, we've got a positive divergence. The equities market should be continuing in the upward direction here. This pairs nicely with the idea that from a technical perspective, sure, we know there are some liquidation breaks. Maybe we're not seeing the proper leadership over here, but we haven't flipped into an hourly downtrend. The S&P is still in an uptrend on the daily chart. We can look for some follow-through based on this as a positive divergence. Let's take a look at breadth. Actually, let's go to Bitcoin first. My apologies. It's still just holding up there high and tight, so overall a risk-on indication. Let's take a look at breadth now, and what you'll notice is a nice push in the upward direction out of new highs versus lows. This is constructive, and it is bullish. Let's take a look at the SPX A200R. Same idea. Let's take a closer look to the left. There we go. Moving in the upward direction. That is a bullish indication as well. SPX A50R rolling a little bit, getting incremental now in terms of higher highs being produced, but we're in contrarian zone. We're in a very, very healthy and bullish place for this. If it pulls back, it's not the end of the world. We know that we can afford a weekly pullback in the S&P. So far, this is not showing any signs of major deterioration. If we're back down underneath 80%, it would be a little bit of a red flag to say, hey, let's start thinking about a pullback over in the S&P 500, but we're just not even close yet. So all good from a breadth point of view there. Let's take a look at some of these equal weight charts, and these continue to suggest as well that things are good. Things are improving. Concentration risk in the Magnificent Seven is being reduced. New higher high in the RSP equal weight S&P 500, and the same thing over here in the QQQE, the equal weight NASDAQ 100, which is certainly over its previous pivot top, This is healthy. This is healthy. Again, concentration risk in the Magnificent Seven is being reduced when you see equal weight indexes continuing to push for higher highs well outside of the previous range high. When we were back down here, yeah, absolutely. It's like if Apple goes, if Microsoft goes, if Google goes, everything is going to go. But now that you have some further tailwind, some broadening of the market rally here, does strike me as a bullish indication for markets as a whole. Industrials versus transports, we're hanging on. Could have been a little bit better. An equal high out of transports down below, and still an equal high up here in industrials. Actually, maybe a slightly nuanced higher high. But for the most part, just want to see continued consolidation. Really do not want to get underneath 15.7 out of transports. That would continue to be a healthy look for the uptrend that's building here. Daily channel supporting the idea that yes, we should move in the upward direction for industrials. If this starts to break down, if this turns into a double top, I would expect a deeper pullback over here. If it becomes divergent, we want to dial back expectations of longs over in the S&P. All right, so that's how you use that one. Let's finish it up with some volatility indications. VIX on its own, interestingly enough, with the liquidation breaks on today's session into the close of yesterday's session, VIX is moving in the downward direction. Now, you did get the end of day rip out of the S&P 500, so it makes sense that we closed weak on the lows over here, but volatility overall, it's just a non-issue at this point. The market is not really pricing in like, oh my God, we're going to have this big volatility event, credit event, none of that right now. VVIX is even rolling in the downward direction. It's still in a very healthy location. We're not floored up against 75, which of course would indicate some sort of complacency effect, not the case as of right now. VIX futures, what's going on with volatility futures? Deep contangos over here, moving into a contango here in the one-day VIX, floored back down towards these lows. Overall, volatility does not strike me as a big issue for this market. If we take a look at the skew, just remember that a lot of people were taking black swan bets up here. That has certainly been mitigated, and if nobody's really thinking like, okay, we talked about this in the weekend update, right? When Wednesday's liquidation break happened last week, that was the time where the sellers who were like out here were like, okay, it's time to go. It's time to rock and roll. The fact that this saw a 100% retracement, it's back down towards the lows of this as a balance, to me would indicate that not many folks are thinking about, okay, here comes the black swan. So if nobody's prepared, then okay, maybe we can see a further downside move. But as of right now, wouldn't seem as though folks are betting against continuation in this market. Apple kicks off the core list of companies on the daily time frame chart for a very particular reason. This, as a previous daily balance, is starting to act as support on the top of that range. 192 is the level, and you can clearly see we formed a daily hammer on today's session. So if this is going to be a mild pullback from the new all-time high, finding a weekly higher low over the top of the previous daily balance, what you want to see is a break up and over the hammer high for a move back in the upward direction. The setup here is very straightforward. Over 193.25, looking for a retracement to this level right here at 195. We can drop it down to the hourly now, actually. So this is your daily hammer. Clear this level, right? This sort of turns into inverted head and shoulders. Very, very shallow right shoulder, but clear the level, retarget this area here, and if we can poke through 195, I think we have a shot at making it back towards the all-time high. If Apple is going to fall from grace, it will produce a lower high underneath 195. This will hold as a double top neckline retest, and the bears will gain control on some sort of breakdown, further control, at least on the weekly higher time frame perspectives, if we fail to hold on to this level here at 192. So this is what the bears want to see. The bulls want to see this move first, and then some sort of either higher low and break or a break and higher low above to become more confident. Overall, if the buyers have a shot at all-time highs, you need to get up and over 195 after holding firmly 192 flat. Let's move along and take a look at Microsoft. What's going on over here? A little bit disappointing to be honest with you. We do have lows, and higher lows are building out, but Microsoft just can't get in gear. It's not producing ideal bullish consolidation firmly up and over that 370, 350 today. Much more choppy through the level. I would prefer to see Microsoft build the consolidation and then break higher low here if we're looking for that follow through. I mean, a good first step is just staying on the upper part of this range here. So 370, 350, although it was very choppy, it did technically hold. We didn't get a solid breakdown underneath it, even with that nasty first inverted hammer on the hourly chart here, but leaves a little bit to be desired. So I would be thinking about Microsoft being a stronger long up and over 376.25. When and if it can do something like this, higher lows, equal high reattempt, looking for the break, or just a straight shot through it, higher low above, trying to trade that in the upward direction for follow through. 379 would become that first target. Then from there, 383.80. Let's move along and take a look. And obviously downside, right? If we just fall into this range, be my guest if you want to trade in here. I will take the hard pass until we actually form a lower high underneath the bottom of range at 368.25, right? Next up is Google. What's going on with Google? A little bit of head and shoulders activity here. Bears are trying to make a stand. We opened at and around the top of this pattern. It was a 2-day high break, 1 and 2. We broke out over it on the Tuesday session, then just kind of consolidated weak near those lows, but technically over 141.50 today. Definitive bear flag consolidation, and most importantly, underneath our key level at 140.70. Looking for follow through in the downward direction. 139 is a first pit stop, but really this gap close underneath becomes interesting at 138 down to 137.50. If this is going to flip back to the bull side of the market, you need to see a higher low over 141.50. Until then, a little bit more neutral in this zone up here. Sure, you're building out a higher low, but for the actionable long, this needs to take place right there. Next up, Amazon. What's going on with Nancy? Some failed breakout here as well in the upper wick of the first hourly bar. Tried to get a stronger break up and over this, but there was just no pullback for the higher low, and instead, equal lows are on the table. So I'm not going to throw in the towel yet out of Amazon because this technically is still just range compression. If we do break, the stronger short is underneath 152 to retrace the thin structure and look for the 150 retest. On the daily time frame chart, this would certainly be a higher low daily. All right, you can actually, let's take a look at that here on the daily. So this is range consolidation. This turns into overhead supply, but if we can catch ourselves for a higher low over the 2-day high breakout point, that looks good for a daily higher low, right? Lows, higher lows, higher lows. Technically, higher lows can also happen here at 150, considering that we are coming from the highest high, and all of this has just been an inside bar, basically, of this session back here on the 20th of December. Next up, NVIDIA. What's going on with NVDA? This is a daily chart that's really not all that insightful. We just have an inside bar, right? Or mostly inside bar. On the hourly chart, though, things become much more clear. This is actually a great chart to be learning from in terms of structure and how markets move. Daily uptrend, this was an hourly downtrend, right? You could technically draw in some sort of downward channel, something that looked like this. This was a double bottom. If that's the neckline, good break on Tuesday, and today we held a higher low above. We're looking for follow through up and over these equal highs. 494.50 gets us to $500.75. That's the resumption of this as a daily upward channel, right? Sure, you got a little bit sloppy through the bottom portion of what was happening over here, but lows, higher lows, higher lows, higher lows, higher lows, continuing that sequence in the upward direction. If the sellers were going to truly materialize in the downward direction in terms of a new trend reversal, this as a head and shoulders should have stayed underneath the neckline. Obviously, Tuesday and Wednesday, that is not the case. So two things that need to hold. Obviously, this one first at 491.20. We flip into a neutral daily trend. If we start to do something like this, then the bears really gain much more of an edge if we start to break down underneath 484. So a great chart to learn about market structure from. This is a beautiful example over on NVIDIA. Next up, Metaverse. What's going on with Zuckerberg's Fantasyland? All the pattern traders, or at least trendline, I shouldn't call them pattern traders, but trendline traders, people who pay attention to trend lines more so than I do. You guys know I'm a fan of horizontal levels, are probably calling this a rising wedge, and I would tend to agree. The main idea of the rising wedge is that you have incremental higher highs, and longs who get sucked in at the terrible trade location, the highest high of the breakout, really aren't being rewarded as much as they'd like. So if there is a liquidation break, if longs say, you know what, that's it, we're out of here, you're looking for something that does this. Some of the concepts that we've talked about in the pre-market preps this week have been the markets sometimes need to break first before they can rally. Shake out some of the paper-handed longs up here, bring in some better buyers on a retest for a daily higher low up against like 337.25, and then we can rock and roll in the upward direction. I'm not saying it has to happen that way, but it would be a decent, that would be a pattern that I would be willing to trade based on psychology and the emotion of people getting involved up here. The type of trader always matters, right? Are you trading against paper-handed longs, or are you trading against institutions who have a 6, 9, 12-month time horizon? That matters when you're thinking about how these people are going to act and what might happen next. So anyways, that's the idea out of Meta. If it does continue to grind in the upward direction, I mean, a viable long, instead of thinking about a daily pullback here for like a higher low, is consolidation that builds out a range. You set some lower lows. You stop this very subtle march in the upward direction. Bring in a lower low. That's fine. Really neutralizes this trend up here. Turn this into a long duration consolidation. Then over time, this becomes attractive for the next big range to trade for. 371.50 becomes that target. All right, enough of that. Next up is Tesla. Really solid break today out of the upper balance, right? We know that on a daily time frame chart, this is a balance. This is a balance. We broke out up and over it on today's session, opening near that 258.50. We got a run and then some sort of pullback back into the afternoon. The name of the game here is very straightforward. Holds of 258.50 are higher low retests looking for continuation in the upward direction. You could either spot it here, or if we make it back up to the top, higher low, something that does this, there are two ways to get involved. The higher low here, or the reattempt through the equal high, or the most confidence inspiring is the higher low outside of the top of the balance range here. This is almost the same entry as what you would be looking for if you can get here in terms of theory of why it would work, right? It's a retest of this level on the daily. Break, retest, higher low. As long as you can hold that, looking more bullish than bearish. If this is going to turn into a look above and fail, I would wait patiently until you get some sort of not just breakdown here, but lower high underneath 256.25. Turn this into overhead supply, turn this into overhead supply. Now you're cooking with fire on any breaks underneath 253.25 for a stronger short to get here, 246.25. Last but certainly not least is Netflix, and then I have 3 trade ideas and you're on your merry way. We've got an early episode today. Here's an inverted head and shoulders. It's kind of pie in the sky, but if you can clear 494, looking for a move in the upward direction, 501 is the bottom of the remainder of the overhead gap, closes at 506.60. Wouldn't really, I wouldn't be aggressive short through here. I would not be aggressive short. You're trying to build out these very incremental hourly higher lows. If the market's going to turn around, if you're going to see a larger breakdown, I don't really Netflix, not for nothing. I don't think Netflix is a short up here. Not for nothing, but let's go to the daily chart. Let's do it this way. I know I just repeated not for nothing now 3 times. So anyways, this is, it's a strong daily uptrend. If you do get a pullback, 481.75 certainly possible to produce higher low consolidation over the last equal high, right? So not really feeling the short out of Netflix until there's some sort of larger break underneath 481.75. That will be the level that you want to pay the most attention to. First idea is on ORCL. Oracle is the name of the game, not the Oracle of Omaha, but Oracle, the tech company. If we can break out over 106.50, we're looking at a gap from the earnings cycle overhead, and the target would be a gap close up around 113.60. Let's be realistic with ourselves. Are we getting there in one day? Probably not, but we do have thin structure to trade for overhead. Ideally, the consolidation stays over 105, and then we get a break higher low, looking to move in that upward direction. If we slip 105 to the downside, it's not the end of the world, but you'd probably want to see a pretty stern recapture, prompt recapture, and something that does this into the future. Anything underneath 103.15, definitely losing interest. You would be failing this as the original balance after the earnings gap down. Let's take a look on the hourly chart just so you can get a better sense of this as well. Notice that you had momentum on the Wednesday liquidation break from what is now a week ago today, and it didn't really materialize in the downward direction. Strong recovery, fell off the highs, but so far, again, you're not really getting a test or acceleration underneath that 105. So as long as we can hold it, trying to trade this in the upward direction over 106.50. Next up, let's take a look at FedEx. FDX also took a little bit of a tumble on the earnings call the other day. If we take a closer look on the daily time frame chart, this is actually a short. It's not the same as what we just saw over on Oracle. This is the original earnings range. We tried to break it on Tuesday. Today's Wednesday session. We tried to get up and over that 50 SMA. No dice. You can see a look above and fail. Here it is on the hourly time frame chart. Let's make this thing easy on the eyes so it's not so harsh to look at. There we go. What you'll notice is in the morning session, we tried to hold. Notice the lower wick in the first hourly bar, upper wick in the first hourly bar. We tried to get that breakout. It failed, and we closed back down inside of the earnings range. So if this is look above and fail, what do we know the target always is? It's the bottom end of the range. It would help if the broad market is struggling tomorrow or into the end of this week, into this end of this year, we can say. If the SPY is not really performing well, FedEx would be a top short watch on that look above and fail pattern. Last but certainly not least is Uber. UBER is the ticker on that one, spelled exactly as the name is. And if we take a look at the daily time frame chart, nothing more than a beautiful weekly, daily, whatever bull flag. Very, very strong bull flag up here at those highs, breaking out for the first daily close up and over 62.90. The all-time high is 64.05. So if this, not for nothing, the measured move, folks will probably correct me in the chat, and that's cool, or the comments, and that's cool. But if you come from the bottom, just for giggles, right? Let's just do this for giggles, laughs. And then down to the bottom end of the flag range, where's the 100% extension? Let's take a look together. We're talking about 83.50. 83.50. All right. Do I think we're going to 83.50? Probably not. Not today, not tomorrow, not in the first quarter of 2024. I'd love to be proven wrong. But I generally think that Uber has the capacity to continue to rotate in the upward direction. Let's drop it on down to the hourly time frame chart so you can see that balance with a little bit more clarity. Then we'll wrap things up here. If this was going to turn into your very classic head and shoulders, right? If this was going to act as your neckline, you had the opportunity last Wednesday, a week ago today, to accelerate. Simply did not take place. We find ourselves 100% retraced retracement back up to the equal high. And for the first daily closes, we just saw over 62.90. Looking for some follow through here, even if it doesn't continue immediately tomorrow. Any higher lows, any pullbacks on the hourly chart that find low, higher low, higher low. Ideally, the higher low wants to be over 62 flat. Let's go 62 flat. Any higher low over that looks constructive for continuation, and based on the strength of the daily trend, which we were just looking at over here, I would be partial to the upside out of Uber. So watching that as our third and final setup into the end of this year. That's going to do it for today's episode of the Midweek Market Update. If you learned anything new or enjoyed the content, let me know down below in the comments section or by giving a very simple thumbs up. We will see you tomorrow morning for our pre-market prep. I wish everybody a fantastic end of 2023. Have a green trading week.